Howdy, Jacob here. Today we're looking at Plains GP Holdings. It is in the oil, gas, consumable fuels industry. 3.8 billion market cap on $10.9 billion enterprise value. Huge amount of net debt here. 6.99% dividend yield. That is pretty substantial. Return on invested capital, not even single digits. We're looking at upper point decimals as an average. So that is pretty crazy. They've paid a dividend pretty consistently since 2014, so that's quite a bit of history. But the dividend itself is not consistent whatsoever. As high as $2.35, as low as 72 cents. Very likely depends on what their earnings and cash flow are, I presume. I need to see this debt here. So 404 million cash on hand with $1.2 billion short term, $7.3 billion long term. We're looking at like $8.4 billion in debt with 404 million cash on hand. That can be troublesome. Let's look at this cash flow. Can it make up for it? All right, capital expenditures are down quite a bit with cash from operations actually up, relatively flat. That's pretty solid. I feel like that would hinder your growth though, but that's interesting to see. On a 5-year average basis, let's see, a billion, 1.4, let's say it's about 1.2 billion. I mean, it looks like they could easily afford this dividend of $200 million, but the company's going to really have to start digging down on paying back some of this debt. At this time, we don't know until we do further research when that debt is due, but the use of cash seems to be pretty heavy recently on debt pay down, bid and acquisitions, and then very consistent. They've paid a lot in acquisitions, and it's always they've made an acquisition every year. Some bigger than others, but pretty consistent. And then paid out a dividend again, varied but pretty consistent in the fact that they've done it. Debt has been all over the place. Sometimes they repay it, sometimes they issue more. Probably just depends on when they make these large acquisitions. All right, this will be a very interesting one because, again, this present value calculation does not include the balance sheet. So that's taken into effect more so when you look back at the company and you try to see how risk tolerant you are. The thing that's interesting is this 0.3 price to book. It looks like if they could sell their current assets and investments and property and plant, $1 for $1. I mean, you're looking at 23 billion with 14 billion total liabilities, which would make $9 billion, and their market cap's 3.8. The only question is that truly what these are worth? If they were to liquidate these assets, which they probably wouldn't unless they were forced to, but during liquidation process, you can see how safe this company actually is if you were to find the true worth of all of these. And so, yeah, the debt could be a problem, but if their assets are worth even 75 cents of what they're saying they are, then there's a chance that even if they were to force to liquidate, it could still make an investment, if you know what I'm saying. By what I mean by that is, like, if they have $24 billion and they sell, let's say it's actually worth 18 billion. 18 billion, subtract your 14.5 for all of your liabilities, you're still looking at 3.5 billion, which is almost what the market cap is today. So the balance sheet is really for safe purposes, safe haven. It's just part of the story. And so as for present value calculation, I would say that, this is going to be interesting. I feel like it's gone up so much recently that I just don't see that sticking. And so I'm going to say that it drops 2% a year over the next 7 years, saying, that it hasn't been really through acquisitions. They have acquisitions, but not like any investment large enough to really make that type of difference. So I feel like that's just the price of the commodity and such. And so I think that there might be some pullback initially, and then it might go towards maybe flat growth or so. And then these margins are interesting where, I mean, at least their free cash flow is so much higher. But is that due to, okay, it's not due to stock-based compensation, so that's good. It's just a lot of depreciation and amortization and a lot of other, which I wonder what that is. If it looks like a deal, I'll have to look at what that is. But we see maybe 0.5 and then, I don't know, 2. And then we've been issuing shares quite a bit. Oh my God, this. Oh, okay, that's why. I was like, it looks like a screaming deal. Okay, it's not totally there. And then, I mean, their payout right now, their payout's less than 20%, really, on a 5-year average basis. And so they're really just going to have to use a lot of that cash to start paying down that debt. And it's just depending on when this debt is due to see if it's truly concerning or not. But I think I'm fine with that dividend without knowing that information for now until I do more research. I think I'm fine with that. So it's going to have to drop 35% before you do 15% return given these assumptions. Are these assumptions perfect? Probably not. I'm fine with them on this initial review. I think so. But if you do more in-depth analysis on this company, you're definitely going to want to learn when that debt is due and see if it's concerning or not. Because I don't have debt considered into here. And that's just going to be a judgment decision on your part if you're willing to invest in something that has as much debt as this. But again, I think another way of reviewing this company could be looking at their balance sheet and saying, if they were to liquidate, what could be that value? And then you subtract all the liabilities. What is that in relation to their market cap? So hopefully everyone enjoyed the video and has a great rest of their day. Thank you.